let us discuss features of a company. So in the previous video, we have discussed introduction, we have discussed definition, we have discussed applicability, and we have also started discussing features. And to some extent, we have also covered separate legal entity feature discussion as well. So quickly, we'll recap what is separate legal entity. The moment company gets incorporated, it took birth. The company took birth. So the date of incorporation is the date of birth of company. So it is created in the eyes of law, and only law can wind up, law can close the company, not by any other person. Mere death of owner, mere death of director, mere death of one shareholder, mere death of all shareholders does not affect the existence of the company. So the separate legal entity is the company is different from its owners. When it got its birth, the date of incorporation is the date of birth of the company. Post that, it has its own legal entity status. So we'll see, it can own the property, it can complain or it can sue someone, it can also be sued by other people. All these are the explanation, all these are the pointers for separate legal entity. And remember, this is the first, the pointers. So when a company is registered, it is cloth with a legal personality. So we are talking about a cloth, we are talking about a curtain, we are talking about wheel. Wheel, for understanding, we can think of curtain. So the moment it got registered, a curtain has framed. Behind curtain, who will act? The directors, the shareholders. These people will act. Mainly directors, right? Its existence is distinct and separate from that of its members or owners. It can own property, have bank account, raise loans, incur liabilities, and enter into contracts. Almost have the same rights like a human being. So members can contract with the company, very much yes. They can acquire right against it or incur liability for it or debts of the company. Creditors can sue, not its members. So the capital which was contributed by shareholders. In the previous video, we took an example that 10 lakhs was the capital introduced by members for incorporating a company and they kept in their bank account. Now company which is run by their directors, they purchase land, they purchase furnitures, they purchase some laptops. Now these laptops, furniture and land belongs to company, not belongs to members. Although they contributed the capital, although the money was coming from that people, but these are the property of company, not the property or joint property of members. That is what the last pointer is all about. Let us see two different case laws to understand separate legal entity in detailed manner. The first case law is Salomon versus Salomon and Co. Limited. So there is Salomon and Co. Limited, which is a company. There is Salomon, who is a member of that company. He along with his family members, along with 7 family members, hold shares in Salomon and Company Limited. So in classification of companies, we will see the moment you see limited, it is public limited company. The moment you see private limited, it is private limited company. We will discuss about private limited and public limited in detail when we are discussing classification of companies based on its members. But here, let us see Salomon and Company Limited is a public limited company. Minimum shareholders are 7. So Salomon and its family members, other family members hold nominal shares like 1 or 2 shares, but Salomon holds more than 90% of shareholding. He also gives secured debt. He also gives secured debt to Salomon and Company Limited. So let us take an example. Salomon has given 5 lakhs as capital to Salomon and Company Limited as a shareholder. He also gives 5 lakh as unsecured loan to Salomon and Company Limited. He also gives 5 lakh secured loan. 5 lakh secured loan to Salomon and Company Limited. And Salomon and Company Limited also got unsecured loan of another 5 lakhs from debentures. Now, Salomon and Company Limited could not able to run the operations, so it is going for winding up. It is going for closure. Who has the right to collect money? As per priority, first comes the secured creditors, then unsecured creditors, lastly your equity shareholders. Now the unsecured creditors who are outsiders, their claim is they should get the money first because the Salomon and Company Limited are not different. And Salomon is holding more than 90% equity share. So the money has to be paid to unsecured creditors who are outsiders first, then Salomon as secured creditor, then Salomon as equity shareholder. The case went to court. The court decided that Salomon and Company Limited are different in legal perspective. The strangers, the outsiders, the third party people, the lenders to Salomon and Company Limited claim that both are one, but the law tells that both are different. The Salomon and Company Limited has separate legal entity. Hence, it will be treated as a separate person. Now, Salomon and Company Limited got secured debt from Salomon. So, first we need to pay secured debt. The lender with security first will be paid. Then the lender with unsecured will be paid next. And finally, Salomon as a equity shareholder will get the money. And if there is anything remaining, it will be given to Salomon. So this is a landmark case law which provides that the Salomon and Company Limited, although Salomon holds 90% of capital, it is separate from the person. It is separate from the natural person, who is Salomon. The Salomon Company Limited is different. So this landmark case provides the significance of separate legal entity. Hope we are clear with the case law. Then we will see another case law, which is Macaura versus Northern Assurance Company Limited. What are the facts of this case? So Macaura, who is the owner of the company, he took insurance on company's behalf. The timber, he has a timber company. So the company has timber as their inventory, as their stock. Insurance has to be taken by company because the stock, the inventory is the property of company, not the property of the owner. So in this case, Macaura unknowingly or mistakenly, he took insurance of timber on his name, thinking that he and company are one and the same. The property of the company belongs to property of the Macaura. But the insurance company, the Northern Assurance Company Limited, they told there is a separate legal entity. The owner and the company are different. Hence, Macaura will not get the claim, will not get the insurance claim. The court gave judgment in favor of Northern Assurance Company Limited, saying that Macaura and company both are different in nature. The property of the company does not belong to the owner. Hence, the insurance claim which was taken by Macaura is not able to claim for damage which was caused for timber, which is the property of the company. This also gives the significance of separate legal entity. In the first case, the case judgment is in the favor of Salomon. In the second case, the judgment is not in the favor of Macaura, but in the favor of Northern Assurance Company Limited. This is with regard to separate legal entity. Next, we will discuss perpetual succession. What is perpetual succession? Mere death of owner, mere death of directors, single director or all the directors, single member or all the members, does not cause effect of existence of the company. So members may die or members may change, but the company goes on till it's wound up on the ground specified by the act. The shares of the company may change hands infinitely, but that does not affect the existence of the company. So if you know the BSE, Bombay Stock Exchange, or NSE, where the shares are listed and the trade happens every day, so the owners, the members of the company changes on infinite basis. So the Reliance shares you can purchase, you can transfer it to your friend for some consideration. Thereafter, he will transfer to someone. Thereafter, it will transfer to someone. But the members may change. However, the company will continue to run the business. It does not affect the existence of the company. So as it is created by law, if you want to end the company, it also should be done by the law itself. So its existence does not affect by the death or insolvency of members. That is with regard to perpetual succession. Then we will discuss about artificial judicial person. As we have already discussed separate legal entity, this is another form of discussing the separate legal entity. So a company is an artificial person. It is created by the process other than the natural birth. It is legal or judicial and it's created by law. We have already discussed this. It can own property, bank account, raise loans, enter into contracts. Same thing which we have discussed. The important thing which we are going to discuss is, as it is an artificial person, it cannot act by its own. It needs some humans to act, to perform certain activities. So the directors were appointed to control the affairs of the company as its agency. So these directors with the common seal, they will do the activities on behalf of the company. They are very much agents for the company, but they are not agents of the members of the company. The rule is very simple. The property owned by company, it is owned by company, not owned by members. The agent who are working for the company will not be agent for members of the company. It will be agent for the company. It will not be members of the company. The property belongs to the company, but not belongs to the members. Quite simple, quite straightforward. Then these directors, how do they enter into transactions? They enter into the transactions through common seal or by their own. What is common seal? What are the options available for a company? We'll discuss in detail. The common seal is the official signature of the company affixed by the officers and employees of the company on its every document. So natural persons will provide their signature, whereas artificial persons like companies, they will, instead of signature, they will put the seal. So it is the common seal is the official signature of the company. Many contracts of dog company will be affixed with this common seal by officers or employees. It's a seal used by corporation as a symbol of its incorporation. So there is an amendment in Companies Act 2015 which tells that the common seal is not mandatory in nature, but it is optional in nature. So if you would like to continue using common seal, you can use. But if you don't want to use common seal, instead of common seal, what directors can do? Two directors can sign, or one director along with the company secretary can be sign on the documents instead of common seal. This was the option given for companies, either to use common seal or two directors or one director with one company secretary signature on the documents. So in the previous artificial judicial person, we told that directors are the people who are acting as agents, who are controlling the affairs by their own or through common seal. Lastly, we will left with limited liability. So in case of limited liability company, so we have three types of company based on liability, which we'll be looking while we are discussing classification of companies based on liability. Here we will take the reference of that. So based on liability, there are three companies. There are three classification of companies. One is limited by shares. Second is limited by guarantee. Third is unlimited company. I repeat, there are three classifications, or there are three classes of companies based on liability. One is liability or limited by shares. Second is limited by guarantee. Third is unlimited company. We are going to looking at limited liability from all three point of views. In case of limited company by shares, the debts of the company in totality do not become debts of the shareholders. The liability of the members is limited to the extent of their nominal value of shares held by them. Example, you hold 1000 rupees of Reliance shares. Now your liability is up to 1000. If Reliance does something wrong and they got a penalty of some 10,000 crores, they got a penalty of 10,000 crores. What is liability of a member? Let us say you hold 1000 rupees worth of shares of Reliance. Now your liability is only 1000. They will not come to going to claim money from you for your personal property. They will claim only up to the extent of your shareholding in that company. Let us say the same thing happened in case of proprietorship firm or a partnership firm. If something goes wrong, it is unlimited liability. The owners, the proprietor, the partners have unlimited liability in case of sole proprietorship or partnership firm. Whereas in company form, the members, the owners has only limited liability to the extent of their contribution in the form of share capital. In case of limited by guarantee shares, in case of limited by guarantee, not by shares, the members are liability only to the extent of amount guaranteed by them. So while framing MOA, they will mention what is the amount of guarantee to be contributed in case of winding up. Let us say in the guarantee they wrote 1 lakh per person. So the liability is limited to that 1 lakh, which is mentioned in MOA as a guarantee in case of limited by guarantee company. You cannot claim more than 1 lakh from the party. You cannot go for claiming their personal private properties in case of any default by the company. So in case of limited by shares, up to the nominal value of the shares. In case of limited by guarantee, the guarantee mentioned in the MOA. Then in case of unlimited company, the liability of its member is unlimited, similar to sole proprietorship and the partnership firm. You rarely see an unlimited company in practical scenarios. One of the most important feature of company is the limited liability. Owners shift from sole proprietorship to company. Joint owners in partnership firm, partners will convert from partnership to company because of this important feature, which is limited liability. So rarely we will see an unlimited company in practical scenarios. We will only see limited by shares most of the time, 98% of the time. Limited by guarantee, very few scenarios where certain clubs are run, certain trusts are run, certain communities like gated communities, the real estate communities, where the company will be incorporated by guarantee, not by shares. Most of the scenarios, 98% of the scenarios, we will see limited by shares only. So hope all the features we are clear. There are 5 features. How to remember? CLAPS, C for common seer, L for limited liability, A for artificial judicial person, P for perpetual succession, S for separate legal entity. These will be asked for 2 marks mostly, or they may ask for 4 marks combining 2 features together, or 6 marks for writing all the features of the company. But mostly the probability of asking individual feature is high. Hence, you should able to write minimum 2 paragraphs to 4 paragraphs in each of the feature which we have discussed. In case of separate legal entity, you can also quote the case laws mentioned, which is Salomon versus Salomon Company Limited, or the Macor versus Northern Assurance Limited. Hope we are done with the features. In the next video, we will see corporate wheel. What is corporate wheel? In which scenarios the corporate wheel will be lifted. Then we will also see classification of companies based on liability, based on members, based on shareholding pattern, and other classifications. Thereafter, we will move into other aspects of the company to cover all the 13 aspects. Thank you.